The United States national debt has crossed $38 trillion, a record high, as interest costs and spending outpace revenues at every level of government. But to truly judge a country's economic health, economists weigh that total debt against the entire economic output of the nation, its gross domestic product. This creates a metric known as the debt-to-GDP ratio. The International Monetary Fund projects this ratio will hit 143% by 2025. Following this trajectory, the United States will carry a heavier debt burden than both Italy and Greece, a milestone unseen in a century. For years, those two nations served as primary examples of fiscal distress, sitting at the center of the European sovereign debt panic of the 2010s. Today, both Italy and Greece are actively stabilizing their finances and lowering their debt burdens over the next decade. The U.S. is moving in the opposite direction. Washington currently runs annual deficits that exceed 7% of its GDP. If America is adopting the fiscal profile of Europe's most infamous debtors, does this guarantee the U.S. is headed for a catastrophic European-style economic collapse? A deficit comes down to simple math. It is a widening gap between falling government revenue and exploding national costs. On the revenue side, massive tax cuts leave the government collecting less money. To keep the federal budget afloat, Washington relies heavily on borrowing. On the cost side, the budget faces immense pressure from rising defense spending and mandatory entitlement programs. Because the U.S. population is aging, the price tags for those mandatory programs, specifically Medicare and Social Security, are accelerating. Severe political gridlock prevents lawmakers from compromising to fix the gap. Neither side is willing to significantly raise taxes or cut those entitlements. During their crisis, Greece faced a specific structural flaw. They borrowed in euros, which was a currency they did not control and could not print. A nation generally only experiences a sudden, catastrophic default when it literally runs out of a currency it has no power to create. This divergence exists because of a mechanism that separates the U.S. economy from Greece and Italy: monetary sovereignty. The United States borrows exclusively in U.S. dollars. That currency is fully controlled by the U.S. Treasury and the Federal Reserve. Because the U.S. controls the printing press, it essentially creates the money it owes. This makes it technically impossible to run out of currency to pay bondholders. The U.S. dollar also serves as the global reserve currency, guaranteeing deep, constant international demand for American debt. Because of this control, global markets view U.S. sovereign debt as inherently safe, making a sudden European-style default practically impossible for America. If the U.S. controls its currency and cannot go bankrupt, does a $38 trillion debt even matter? It matters because the true danger takes the form of a slow, invisible erosion known as crowding out. As the Federal Reserve enacts rate hikes to manage the broader economy, servicing all of that existing debt becomes massively more expensive. Look at this chart. Every 1% increase in interest rates adds roughly $380 billion to annual borrowing costs. This cost now surpasses all federal spending on education and transportation combined. This cycle creates a dangerous debt spiral. The government is forced to borrow new money solely to pay off the interest on its old debt. This cycle crowds out the private sector and eliminates the fiscal space Washington needs to respond to future emergencies, like pandemics or geopolitical conflicts. The true American debt crisis is a slow-motion suffocation of economic growth and decaying infrastructure. Surpassing Italy and Greece isn't a sudden cliff. It's the moment the U.S. enters the fiscal territory once used as a global cautionary tale.